Good morning, everyone. Welcome to Above Board, a webinar that's focused on the fiduciary and financial responsibilities of nonprofit board members. I'm Julie Clark, Vice President of Nonprofit Engagement with Business Volunteers Unlimited, and along with HW&Co, we are so pleased to bring this session to you today. HW&Co has partnered with Community Leader to highlight relevant nonprofit topics, and then we're pairing each of those articles with a webinar so that we can dig a little deeper into the topic and have some more conversation around it. So really excited to bring this to everyone today. A really brief overview of our agenda. We're going to start with Terry Troy of Community Leader. He will share a bit about his interviews for the August magazine article. Then we'll hear from John Krasansky of HW&Co about the financial responsibilities of board members. Tom Eubing will go over the legal aspects of board responsibilities. And we'll close with Kim Ferenchek of Oswald, reviewing board risk management considerations. We have a jam-packed hour, as you can see. There's so much to get to. Just a little bit about BVU, where again, we're so happy to partner with HW&Co on this. At BVU, we serve as the bridge between the businesses and nonprofit communities in Northeast Ohio, and so we work to connect, educate, and consult to make sure that we've got a vibrant and inclusive community through volunteerism. So if you are a nonprofit and looking for help for your organization, or if you're a business professional who is looking to give help, maybe serve on a board, provide some guidance to an organization, we're the place, and happy to connect with you, and you'll get all of our contact information following the event as well. Last year, we worked with more than 1,000 different nonprofit organizations across a broad range of mission areas, from health and human services to education, the environment, and more. No matter the mission, each organization has a board that has the ultimate responsibility for the organization, and it's never been more important for a board to understand and embrace its responsibilities, which leads us to our conversation today. When we talk about the role of the board, we break it into 7 basic areas. The first is to determine your mission, vision, and strategic direction. The second is to establish and strengthen community relations, be those ambassadors. The third is to select and support the chief executive. The fourth is to develop funding resources. The fifth is to provide financial oversight. Sixth, to ensure legal and ethical integrity. And then finally, to develop the board. The care and feeding of the board is the board's responsibility. So as you'll hear today from our speakers, risk awareness, mitigation, and management are critical components of the board's work and cut across each of these responsibilities. So let's get to the conversation. First up is Terry Troy. Terry has a professional journalism career that has spanned more than 40 years. He currently serves as executive editor of Cleveland Magazine's Community Leader and as editor of Cincy Publications' Ohio Business Magazine. He also writes features for Northern Kentucky Magazine and Dayton Magazine, among others. He is an award-winning journalist with statewide awards from the Cleveland Press Club for magazine feature writing. He's interviewed local and national celebrities for books and has underway, he's currently working on a Civil War spy novel. So we'll be looking for that here in the future, Terry. So Terry, take it away to kind of share a little bit about, and I've got it here, Community Leader Magazine, and talk a little bit about what you heard from the folks you talked to.
Thanks, Julie. I think you kind of overhyped me a little bit there, but that's okay. First of all, good morning, everyone. As Julie mentioned, this is Above Board, which is a webinar presented by HW&Co and Business Volunteers Unlimited. The webinar is a companion piece to an article that ran in the most recent August issue of Community Leader, which is a sister publication to Cleveland Magazine. In that article, we examined the responsibilities executive boards have in creating, funding, and maintaining nonprofit organizations. While their mission is often altruistic, we found that nonprofit boards face challenges that are every bit as formidable as major for-profit businesses. Indeed, many of the challenges faced by nonprofit boards are every bit as complex and as important as Fortune 500 companies. A nonprofit must operate like a for-profit company if it is going to achieve its ultimate mission and survive, regardless of what that mission is. The board is ultimately responsible for the nonprofit's budget, getting it approved, and then challenging management to implement operations that adhere to that budget. Often these are challenges and issues that must be addressed on an almost daily basis. That makes it imperative that nonprofit board members understand their roles and responsibilities. They need to work with nonprofit management, holding people accountable and asking the right questions. But they also need to surround themselves with the right people who are sitting at the board table with them. Having the right mix of talent on the board is essential to a nonprofit's success. They don't all have to be a financial wizard. The board will also need to create committees. True, some will be in audit, financial, and investment roles, but people with strategic planning and operational backgrounds are also very important. It's also important that the board considers succession planning, not just for nonprofit management, but for key roles within the organization, such as marketing, fundraising, and HR. Nonprofits of any appreciable size are also subject to regular audits, so board members must be aware of their fiduciary responsibilities. A finance committee works with auditors to understand risks and then works with management to make sure a control structure with proper checks and balances is in place. If there are any issues with an audit, it could impact a nonprofit's ability to finance, operate, or do proper fundraising. One of a nonprofit's key responsibilities includes the filing of Form 990, and you'll hear a lot about that. The tax form the IRS uses for nonprofits. The board signs off on Form 990, indicating that they have had a chance to review it, and also they have approved it. So the board must understand the nature of nonprofit expenses and how they are broken out, especially in three different expense categories. One, the nonprofit's mission or charity. Two, the administration and operations, and of course, all expenses related to fundraising. This can also be shown to potential donors and other benefactors to demonstrate how their funds might be distributed by the nonprofit, which has become extremely important to potential donors, especially today. While the board shares responsibility as a group, individual members could also face potential risks that come from serving on the board. Thankfully, many of these are easily mitigated, at least from a legal perspective. Board members may have to sign off on the proper disposal of assets or distribution of assets and keep track of those expenditures for tax purposes. This means understanding IRS rules for tax-exempt 501c3 organizations, which includes not violating private inurement rules. These forbid the diversion of a nonprofit's money or assets to private individuals or insiders instead of distributing or using them for the charitable purposes for which they were intended. If you're thinking of serving on a nonprofit, do some homework on the organization itself. Talk to people, including former board members, about their experience with the nonprofit. Conduct internet searches to see if the nonprofit has had issues in the past, and if so, how they overcame those issues or challenges. And of course, never join a nonprofit board unless the nonprofit has agreed to identify board members in the event the organization is subjected to some sort of legal proceeding or lawsuit. But this is pretty standard practice. Despite what seem like an insurmountable number of challenges and possible caveats, serving on a nonprofit board can be a very rewarding experience. It often fulfills a very satisfying personal need for community service, but also offers unique executive experience and can build executive contacts and relationships that can further any professional career path. So we encourage you to serve if at all possible. With that, I'll turn the webinar back over to Julie.
Okay, well, thank you, Terry, for framing our conversation today. And we're gonna, as I said, dig a little bit deeper into some of these particular areas as we move forward. So next up, we have John Krasansky. John is an audit principal and the director of business development at HW&Co. He serves on the firm's board of directors and management committee. John has extensive experience as an auditor, consultant, and business advisor for nonprofits and privately held companies. He also has a lot of board experience and actually is an alum of BVU's board matching program from years ago. He previously served as board chair and now serves on the board, finance committee, and executive committee of the Centers for Dialysis Care and the Centers for Dialysis Care Foundation. So at this point, let me turn it over to you, John.
Thank you, Julie. I appreciate the introduction. Can you hear me, Julie? Good. Sorry, I had some sound issues had some sound issues earlier and just making sure everything is still working. So yeah, Julie did a great introduction. I don't think I need to get into anything more about myself, just kind of expanding on a few things that Terry had mentioned from a financial perspective. But even before we get into that, how do I advance the slide here? There we go. What I did want to talk a little bit about is just the current environment, the current economic environment, really what nonprofits are facing. So when you look at it, these are all the challenges that management is facing, and then also obviously the board who's overseeing management. And taking a lot of these things into consideration is why it's so important to really challenge a lot of, to really budget like a for-profits, really challenge a lot of what the nonprofit wants to do to make sure that it makes sense with everything that's going on economically. So when you look at nonprofits now, we're really concerned about financial sustainability. Over the last 3+ years, there's been a lot of COVID relief money that came into nonprofits, and whether it be the PPP or the ERC or even just any of the stimulus funds that came in, depending upon depending upon the area that your nonprofit operates in. But a lot of that money is dwindled or is gone. The money's not coming in anymore. If you had some still left over, you've pretty much spent it as a nonprofit. And so now what's next? What is the new normal? And just really looking at that. And when you're facing the new normal, there's obviously the concerns about the rising labor costs and supply costs. We've seen a lot of that. And even if that levels off, it's still much higher than it once was. And how do you combat that? And also there's other decreases in funding, whether it be from your donors. Maybe they're not, because everything costs so much more, they don't have as much disposable income to maybe give to your cause anymore. So how does that impact with the donations that you're receiving? And then when you're looking at that, and we'll talk about a little bit later on the slide deck, is looking at our program expenses in relation to total expenses. And with rising costs, does that kind of get a little bit, does that dwindle a little bit? Does your percentage dwindle a little bit on that in that regard? So we'll touch on that. I'll explain that a little bit better in a couple of slides. And then lastly, if you're trying to keep up with everyone, depending on the nature of your nonprofit, is there a lot of technology that could benefit what you're doing? But most importantly, and this is impacting everyone, is data security with all the different breaches and all the different hacks, really making sure your data is secure, and that's not free. There's a lot of cost that goes into that. So again, just continued rises in costs for all the nonprofits, and how do you manage that as management, as well as oversee that and give management guidance from a board perspective. And then just to level set, I know pretty much everybody on here probably knows this already, but when you're really looking at it, what is the board of directors in the nonprofit sense? Really, it's the boss of the CEO. Even in the for-profit sense, there would be a CEO that would report to the board of directors. And generally, the board is responsible for the CEO's compensation, his bonus, and succession planning. And to put it frankly, it really oversees all aspects of the organization, even though the board's not really involved in all the day-to-day issues that maybe necessarily arise. And that really falls on the CEO, who's really responsible for the day-to-day operations, as well as organizing, developing the strategic plan, and the CEO reports to the board. I think when you're, if you're on a board, depending on how often you meet, you may not even talk to the CEO or understand what's going on between board meetings, depending upon your role within that board. But if you're on a board's executive committee, or if you're the board chair, you're probably a little bit more involved. But generally, the CEO is going to handle all the day-to-day and just update people as necessary from a board perspective, or if they need advice on how to handle something that's occurred, on that given day. Oops. Trying to advance the slide here. Oop. Okay, whoops, went too far. Is there any way that we can go back? I apologize, with my sound issues, I had to unplug my mouse to use the headset, and now I don't have my proper mouse, so. Perfect, thank you. Next slide. Okay, so when we're looking at board composition, Terry had mentioned this in his intro, is, you really want to balance talents across the board. Everybody coming on doesn't have to be a jack of all trades. You don't have to be, outstanding at finance and then really understand the strategic. It's great to be able to provide insight in all ways, but you don't have to be that jack of all trades, master of none. So I think it's good when you're looking at board composition, let's identify key people. And, if you look at a board, there's boards are a lot of different sizes. They could be as small as 5 or 10 people or as big as 40 people, right? So you just want to have a good percentage of each type. So here's some finance gurus, whether they are auditors themselves or maybe they're investment guys or gals that ultimately could help if there's a foundation or an endowment within the nonprofit to really advise on the investment side. But then you need the strategic and operational too, as you put together strategic plan. And I think over time, as you get on a board, especially if you're someone like me that came from more of a financial background, when you're on the board long enough, you really start to pick up some of the strategic things, and you're really able to then provide a little bit more input on all areas. But as you're getting onto a board or as you're new on a board, you don't necessarily need to have all those traits. You should just have a specialization that the board needs at that point in time, and that will help them, and that'll help get you integrated into that board as well. Boards typically have a lot of subcommittees. You may have the finance or audit committee, especially if you're large enough to have that audit need. I'd mentioned investments. If you have investments foundation, you're going to want an investment committee that's going to meet with your investment managers to help develop strategy and what should our balance be in our portfolio between equities and fixed income, and do we want to get into alternatives? All those things aren't just decisions for management to make. That's also for individuals on the board or the investment subcommittee to weigh in on and be comfortable with that. And I think most importantly, because I think this is where it all starts, is a strategic planning committee. Without having a strategic plan, how do you know which direction you want to go? And once you know that direction, then you can say, well, how much is that going to cost? What are the resources necessary to pull off the strategic plan? So I think that's one of the more important committees. And quite frankly, a lot of times in board leadership, a lot of the board leaders start on the strategic planning and then kind of work their way up through it. But you certainly could start on any committee and end up in any leadership role within the board at a later date. I'm going to try to change the slides again. Okay. And Terry had mentioned this in his intro as well. I mean, really from a financial perspective, the board is overseeing that budget process, right? We want to budget it like a business. Nonprofit does not mean no profit. If you don't make money or have a plan on how to fund deficits, then ultimately the long-term success of that nonprofit is definitely in question. There would definitely be going concern. And when you go through that budget process, really it starts with the CEO, the CFO, management. They're going to put together the budget and they're going to say, this is what we think. And as a board, and the board I'm on, we handle it more at the finance committee level. We go through that budget pretty much line by line and challenge the assumptions within each area. I think that's really important to challenge the assumptions. If the assumptions aren't good, obviously the input's not good, which means the output isn't good. You want to take into consideration too is the nature of what the nonprofit does is it's cyclical. And so making sure that if you're looking at it month by month, are they being realistic in certain months where maybe the revenue flow might not be as heavy in later months, and how is that taken into account? So just making sure we're challenging each of those things from a cyclical as well as a total perspective. And then most importantly, tying it into the strategic plan. Really, the strategic plan is going to drive the goal setting for the CEO and the nonprofit, and then that budget needs to support that. If we're looking at growing, where are those dollars coming from, and are those contemplated within the budget itself, or is there going to be a lot of surprises next year and you don't want the CEO to come back and say, well, it's in the strategic plan, so I should be able to spend it. Well, you want to vet that as you're going through the budget process and make sure it's been contemplated so that those resources are guaranteed to be there when you need them. And then also the independent audit process, if there is one, it's important that the finance or audit committee members of the board are meeting with the auditors. There's a requirement for the auditors to have a planning meeting with those charged with governance. So that should be at least one representative from the board. Maybe it's the finance committee chair. Just making sure you understand the risk assessments, also providing input to the auditors to say, hey, we really want you to focus on this area this year more so than others because of X, Y, and Z. And then the auditors, would take that into consideration in their risk assessment and ultimately the procedures that they're going to do in their audit. And I'm going to flip to the next slide. And then it's kind of a segue from the other slide is when you're going through the audit, part of the requirements of the financial statements is to have a statement of financial or a statement of functional expenses, whether it be a statement or whether it be actually a footnote that breaks it out. And those functional expenses are program, management in general, and fundraising. Those are the three categories. So you're going to see that on financial statements. You're also going to see it on the 990. And the 990 in some regards is almost more important than the audited financial statements, which as an auditor, it hurts me to say that. But the reason I say that about the 990 is the 990 is a public document. It's available for public inspection. So anybody can go and get your 990, and within that they can see what all of your key management people are making, what's the compensation there. So again, from a board or committee perspective, it's important as we're determining the CEO's compensation, or maybe even looking at and approving compensation for the CFO, COO, if there is one, is that reasonable? Is that market, or is that going to stand out when someone looks at your 990 and says, boy, you know, key management is making a lot of money. I feel like if I'm going to put dollars into that organization, they're going to be using it to pay these key individuals and maybe not putting enough of it towards the mission, right? And that's also why it's important to have a good spread between program management in general and fundraising expenses, and that you want the majority of your expenses to be in the program. So someone coming in can look at it and say, you know what, 70, 75%, 80% of their expenses are program. That gives me confidence that if I'm donating to the organization, then 70, 75, or 80% of my money should theoretically be going towards programs and not management in general, or even fundraising where we're investing to chase additional dollars from other individuals. So it is important that that IRS Form 990 is looked at by finance committee members, by the board before it gets finalized, making sure we're comfortable with, you know, all that the compensation is in line, and most importantly, I think the functional expense allocations are reasonable and aren't skewed to the point where it could hurt the organization if someone were to look at that and start digging into it a little bit further. And with that, I think that was my last slide. I think turn it over to Julie. Appreciate you tolerating my troubleshooting.
Thank you so much, John. Appreciate that perspective and the importance of the board really having a strong handle on the financials and how that structure might look like a business. Absolutely. I did appreciate John's comment. Nonprofit doesn't mean no profit. All right, so let's bring an attorney into this conversation. Tom Eubing has been practicing law for close to 40 years and currently serves as Vice President and General Counsel for Centers for Dialysis Care. Prior to joining that organization, he was in private practice for many years. And over his career, Tom's work has focused on corporate law, including mergers and acquisitions, governance, taxation, and healthcare. And I'm going to turn it over to you, Tom.
Thank you, Julie, and good morning, everyone. As noted, I am General Counsel for Centers for Dialysis Care. CDC is a regional nonprofit dialysis provider. We own and operate 17 dialysis facilities in the Northeast Ohio area. It also happens to be our 50th anniversary this year, so a big birthday celebration. So over the next few minutes, we're going to be talking about what kind of exposure you may have individually as a director of a nonprofit entity in the state of Ohio. We'll also talk a little bit about how we mitigate the risk of that as well. So I can't seem to advance the slide. Phyllis, could you? Yeah, thank you. Before getting into that, though, I thought I'd spend a minute or so just talking about the difference between a nonprofit and a tax exempt. These two phrases are typically used interchangeably. In most cases, that makes sense, but they are two different things. A nonprofit organization is an organization that is formed under state law, Ohio law in this case. And most of these are formed as under Chapter 1702 of the Ohio Revised Code, which is the Ohio Nonprofit Corporation Act. So the vast majority, as I said, are formed under this act. However, in Ohio, a limited liability company can also be a nonprofit organization. That's very rare, and you don't see too much of that. But as we move forward, you may see more and more of that. As previously noted, one thing that's not in the Nonprofit Corporation Act is any prohibition on making a profit. Nonprofit organizations really need to make a profit to keep the organization going. I've often heard the phrase, no margin, no mission. And that's definitely true for most nonprofits. A tax-exempt organization is separate, really different than a nonprofit corporation. It is an organization that's formed under state law as a nonprofit, but it must be able to comply with certain Internal Revenue Code provisions in order to be exempt from federal income tax. Charitable organizations typically qualify under Section 501c3 of the Internal Revenue Code. However, a nonprofit corporation doesn't automatically become a tax-exempt organization. It must file an application to be so, and the IRS must approve that application. Typically, that's a whole process where a lot of back and forth between the nonprofit organization and the IRS. Why I make this distinction is really because both of these implicate different levels of laws. The Nonprofit Corporation Act is a state law. So you have certain obligations under that act. Tax-exempt organizations really implicate federal law and the Internal Revenue Code provisions that are applicable to them. As we go through here, I'm going to assume that we're talking about a nonprofit corporation formed under the Nonprofit Act in Ohio, and that has also applied and received tax-exempt status from the IRS. Phyllis, the next slide, if you could. So under the Ohio Nonprofit Act, here's the obligation of a director. Basically you're required to perform your duties of a director in good faith, and in a manner that you would typically that you would use your own, if you yourself were being the person or your own affairs, you're supposed to run the affairs of the corporation really with the same good faith as you would if you were running your own. So that's the general obligations of a director. Next slide, please. So what are the personal risk and exposure of being a director of a nonprofit? Well, one is a breach of fiduciary duty, and we'll get into this a little bit more. That's really a state law exposure, but there are also what I call statutory liabilities or potential statutory liabilities. And these are examples. This is certainly not an exhaustive list, but one is, for example, trust fund tax liabilities. Trust fund tax liabilities are when you have an employer who withholds federal income tax, the employee's share of FICA, the employee's share of Medicare, and is required to pay those taxes over to the federal government. They're called trust fund tax liabilities because, in essence, the employer holds those in trust for the government. If those are not paid over to the government, then people that are responsible for those not getting paid over to the government are personally liable for those liabilities. Directors can fall under certain circumstances. Directors can have liability under this, and it's personal liability. Another example is tax compliance liabilities. Under the Internal Revenue Code, there's provisions that are in the aggregate are referred to as the intermediate sanction provisions. They are there to place penalties, fines on directors, personal liability on directors that do not comply with the IRS rules. They're called intermediate sanctions because before they were in place, the only recourse the IRS had against a nonprofit not complying with the rules was termination of their nonprofit or their tax-exempt status. A pretty harsh result. So they brought in these intermediate sanctions to really apply without having to terminate a nonprofit status or tax-exempt status, excuse me. Another potential statutory liability, and this is under the Ohio Nonprofit Corporation Act, is the improper distribution or disposal of assets. The assets of a nonprofit are supposed to be held for the mission, the purpose of the nonprofit and its mission, and not to be used for any other purposes. So if the organization improperly distributes or disposes of their assets that's inconsistent with that, then the directors can have personal liability if they voted and approved that disposition or distribution of assets. Next slide, please. So let's talk a little bit about fiduciary duties. In general, directors have fiduciary obligations to further the mission of the organization and to ensure the organization's resources are appropriately used in support of the mission. Well, that's pretty general and pretty straightforward. But there are specific duties, and we're going to go briefly through each one of those. So the first one is the duty of care. So a director has a duty to handle the affairs of the organization with the same care and attention they would handle their own affairs. This includes preparing, attending, and participating in meetings. I've been involved in a lot of nonprofit board meetings, and I would emphasize that if you are a director or anticipating becoming a director, that you take this duty very seriously. Some organizations are more complicated than others. Some of the materials for board meetings are more expansive than others. But I think it's very, very important that you, before you attend a meeting, you get up to speed as to what's going to be discussed at that meeting, and participate in the meeting. I just think it's the best way to go, and a lot of people surprisingly don't do that. And I think I would emphasize that if you're going to be a director, it's a very important thing to do. Next slide, please. The next duty is the duty of loyalty. So you need to place the interest of the organization above any other personal interest. When you become a director of a nonprofit organization, most nonprofits, if they should, you're going to sign a conflict of interest statement. Because every nonprofit has a conflict of interest policy. This, of course, is designed that you don't want a director to be in a conflict with the organization. For example, having a contract where the director is receiving some type of financial benefit under that contract. So it's important that everyone knows if there are conflicts, what those conflicts are. And so it's very important to understand and comply with the conflict of interest policy of the organization. Next slide, please. The next duty is the duty of compliance. And this is a pretty broad duty. You need to ensure the organization is complying with federal and state law, governing documents, and contracts. One important aspect, I think, is understanding the organization's governing documents. And what we're talking about there are the articles of incorporation of the organization, which, by the way, you can pull off any articles of incorporation of an Ohio nonprofit off the Ohio Secretary of State's website. But you need to understand those. And you also need to understand what are called the Code of Regulations, which in other states are called bylaws, but in Ohio they're called Codes of Regulations. And the Code of Regulations basically sets out the internal workings of the organization, how we elect directors, how we get rid of directors, how we handle vacancies of directors, member meetings. It will include a lot of different things in there. But you should be familiar with that and make sure that the organization complies with those provisions. In larger organizations, that's typically handled by in-house counsel like me or outside counsel. But if you're with a smaller organization where resources are limited, it's going to be upon the directors to make sure those are followed. It's also important to understand IRS tax-exempt rules and regulations. I think Terry mentioned the prohibition on private interment. The concept there is, again, the assets of the organizations are to be used to further the mission and purpose of the organization and not to benefit any private individuals. That's the general concept of the prohibition on private interment. In the IRS world, under their provisions, I mentioned we have these things called intermediate sanctions. And they were way too complex to go into in this discussion, but the idea of intermediate sanctions is that there's a prohibition on something called excess benefit transactions. And that's basically means someone's getting a benefit above fair market value. So some of the assets of the organization are being improperly paid. A good example of this is excessive compensation. So as a board member, you may participate in the approval of a contract for the new CEO. That CEO should not be paid any more than fair market value. And if that CEO is paid more than fair market value, you may have an excess benefit transaction. And if you have an excess benefit transaction and you participated in the approval of that contract, you may have personal liability for that excess benefit. The idea is, like I said, I really can't go into these in great detail, but it's important to understand the private interment and the intermediate sanction rules. And my experience is a lot of directors of nonprofit organizations really don't. So I would recommend that you get up to speed. You don't have to become an expert, obviously, but you need to get up to speed as to what the potential exposure areas are. You need to be familiar with state and federal laws relating to the nonprofit organizations, and this may be dependent on what the organization does, right? In the healthcare world, which is where I live, you have to deal with HIPAA, privacy rules, fraud and abuse rules, and a director, again, doesn't need to be an expert on those rules, but certainly needs to understand the big picture at 20,000 feet, how those rules apply to the organization. Again, oftentimes with bigger organizations, you will rely on outside counsel to handle that, or inside counsel. But again, the director needs to be familiar with what laws are applicable to the nonprofit organization. Next slide, please. Another duty is the duty to manage accounts. John kind of already went over this. That's really to ensure the organization's financial stability. Directors really have a duty to establish procedures that help the organization operate in a fiscally responsible manner. Typically, that would involve, developing and approve annual budgets, and the other matters that I think John went into a little bit of detail on. So, next slide. So now we got all these duties, we have all this exposure, and the question is, how do we mitigate this risk and exposure? The good news is, I don't want to scare everyone from becoming a nonprofit director. There are some statutory regulatory protections. For example, under Ohio law, to prove a breach of fiduciary duty requires clear and convincing evidence. That's a pretty high standard to explain. In typical civil litigation, all the plaintiff has to prove is a preponderance of the evidence, which is greater than 50%, is the way I view that. In the criminal area, you got to prove beyond a reasonable doubt. Clear and convincing evidence is somewhere in between these two. Exactly where is a little bit fuzzy, but it is in between. It's certainly a higher standard of proof than you need in your typical civil litigation. It almost serves as a presumption that what the director did was okay, and the plaintiff has the real burden to show that it was not okay. Under the intermediate sanction rules that I described earlier, there are safe harbors. For example, if you get involved with looking at the compensation of a CEO, there is a safe harbor that you can use, that if you comply with the provisions of the safe harbor, you can be pretty confident that you're not going to have any exposure or liability for approving that compensation package for the CEO. There are also some proactive mitigation steps you can take. I think it's imperative that before you become a director of a nonprofit organization, that you do some due diligence on the organization itself. Talk to prior or former directors if you know them. Do Google searches. Check out their articles of incorporation on the Secretary of State's website. Just find out as much as you can about that organization to see if they've had any issues in the past. The other thing is I think it's imperative that that you confirm that the organization indemnifies board members to the fullest extent permitted. So under the Ohio Nonprofit Corporation Act, a nonprofit corporation is permitted to indemnify officers and directors in the event they're rolled into litigation. There are some qualifications on that that I'm not going to get into, but at the very least, you should make sure that before you become a director, that you make sure those indemnification provisions are there, and those indemnification provisions really provide indemnification to the fullest extent permitted under the Ohio Nonprofit Corporation Act. And finally, and I think the next speaker is going to go into a little bit more detail on this, it's imperative that you ensure that the organization has directors and officers coverage for board members. This is pretty typical, but smaller organizations, due to the cost involved, may or may not have this insurance in place. I think it's imperative to have the insurance in place. The indemnification certainly helps, that I mentioned earlier, but the insurance is probably a better coverage and better mitigation event than to just rely on the indemnification. The indemnification is only as good as the finances of the nonprofit organization. So with that, I'll throw it back to Julie.
Thank you so much, Tom. Appreciate you talking us through how to mitigate risk and exposure, and again, a great lead into what Kim's going to talk about. So Let's round out our discussion today with Kimberly Ferenchek. Kim is Senior Vice President and the Director of the Executive Risk Practice at Oswald Companies. She has specializations in global programs, management liability, professional liability, cyber and privacy, and fidelity, and combines her product and market knowledge to help businesses solve their challenges that arise on a daily basis. She also has a lot of community engagement, founding member of Oswald's Women's Leadership Committee, and serving as a prior board member of Cleveland's Alzheimer's Association. So Kim, close us out with what do we need to be doing and thinking about for risk mitigation? Take it away.
Thank you, Julie. Sure, thank you for that great introduction. And the first few slides of my presentation is just an overview of the duties that we already talked about. So I'll just briefly go through those. And so the duty of care, which Tom outlined as acting in a prudent manner and making sure you're very active in attending board meetings as you would any kind of board situation. So duty of loyalty, placing the best interest of your organization over any other. And then the duty of obedience, being aware of the laws, and then also being careful to not break those laws while carrying out the mission of the entity that you're serving on. There are other duties that are subsets of that are particularly important to insurance. The duty of confidentiality, keeping information, confidential information private. That has to do with cybersecurity. Duty of prudence, exercising caution when making decisions, and making sure that you're very aware of risks for your particular organization. We're going to talk more in detail about that. And then the duty of disclosure relative to making sure that you're transparent about any kinds of conflicts of interest that might influence your decision making on the board. But the areas that, or the area that I'd like to focus most on in this presentation is just making you aware of everything that can impact what you do on the board relative to risk transfer. So any kind of insurance can become, or any kind of risk can become a D&O claim. And that is because when it comes to oversight and governance, everything can flow up to the board. So simple things that most board members don't think about that could become a D&O suit are, did you have a good property and casualty program in place? Do you have good automobile policies in place? So think about if you sit on a board and there's a great big fire at one of the locations that you own or lease. Is the board aware, or do they think about regular maintenance of that location? Are there current tags on the fire extinguishers? Are the elevators maintained? Because if there were to be a claim and that's not covered by insurance, those dollars that are paid out to pay for damages come from the bottom line of the nonprofit that you serve on. Same situations in the casualty space, especially if you're in health and human services, or if you sit on the board of a school. Molestation and abuse is a huge exposure. Are you aware of the coverages that you have in your casualty program? Do you have sublimits in there? Does the excess sit over it? But essentially, as a board, are you aware of those risks? Are you holding the entity responsible for instance, annual abuse training and background checks? Are you doing background checks before you hire folks? Then do you do background checks maybe every year or every 2 years to make sure nothing has come up that could prevent that sort of claim from coming in? When it comes to governance, all of these types of exposures, the harmed parties could say, yes, you had good insurance policies in place, but as a board, were you asleep at the wheel because you never asked the questions about, do you do background checks, right? Same thing with automobile. If you have clients that you're transporting, or even just your employees driving, most organizations have employees driving their own vehicles from time to time. So do you conduct MVR checks at hire and then annually, or at least biannually after that? If you own vehicles, is there regular maintenance of those vehicles that's going to help to prevent a loss? And then are you requiring minimum auto insurance for all of your drivers so that, you know, if an automobile accident were to happen, there would be protection and those dollars wouldn't have to come off of the bottom line of your balance sheet. Most commonly understood oversight areas when it comes to D&O is what we've already talked about a little bit earlier, fiscal leadership. So the oversight of leaders. Two prior speakers talked about executive compensation, and I want to also emphasize that that is one of the most common areas that we see in the D&O space when it comes to governance and oversight, making sure that the leaders are paid appropriately, that they are selected appropriately, that they are vetted appropriately, and fiscal discipline, of course, treating this nonprofit board's financials as if they're for profit. That's what we're looking for. That's what underwriters will look for. And is there a uniform process in place to avoid the misuse of funds? Again, a very big area in terms of D&O suits is that what was the board doing while there was potentially funds being misallocated for personal gain? So what can you do as a board member to make sure these things don't happen? You can make sure that there are audited financials that take place, that you hold the leadership compliant relative to the budget, that you do have separation of duties that would prevent potentially fraud, and that you can offer your entity or your company a program such as whistleblower red flag reporting, where someone can call a line that's confidential and say, I suspect that there might be something going wrong in this area, whether that's fraud, whether that's a hostile work environment, whether it's something else. Just basically a safe place for someone to call and say, hey, I think there's something wrong here. That's because most claims are arisen, or most exposures, potential exposures are arisen by internal audit. So if your organization isn't big enough to have a formal internal audit program, you can at least offer someone a whistleblower program. Then is your insurance program suitable? So do you have all the insurance that you need? When was the last time you did an insurance audit? Both for property casualty, which we talked about a little bit previously, for your management liability and your cyber coverages, and for crime. And when was the last time you had a limits benchmarking that said what you were buying relative to your peers is in line? These are all ways that the board can demonstrate that they are being prudent relative to the operations of the organization. And then is the board informed about emerging risks, such as artificial intelligence and the risks that come with that? Pixel tracking in terms of cyber, we're going to talk a little bit more about that in a few minutes. And then, of course, the board seat liability that exists. Fragile financials impact the ability of the entity to indemnify the individuals. We already talked a little bit about reviewing your bylaws, making sure that the bylaws are current, making sure that the indemnification provision in those bylaws allows the entity to indemnify you to the full extent permitted by law. That's very typical. And then is the D&O policy with a reputable carrier, someone who writes a lot of nonprofits, and are the limits adequate relative to benchmarking? I'm going to talk in a minute about the three sides of D&O, but particularly for board members, there is an interest in side A, which is the non-indemnifiable individual coverage. So there are three sides to your directors and officers insurance program. Sides A and side B are both individual cover. So side A responds in a situation where the entity cannot or will not indemnify the individual. Typically it's due to bankruptcy. So that's usually a situation where the entity cannot indemnify just because there are no dollars left to indemnify. Because it is a non-indemnifiable individual coverage, those dollars go directly to the individual, and so there's no deductible. It is essential that you have a dedicated side A provision, meaning a side A that isn't shared with side B or side C, so that you can make sure there are some dollars left to protect your personal assets. Side B is a situation where the entity is allowed to indemnify the individual and does so, and because of that, it follows the deductible on the policy that side C is, and side C is entity coverage. Entity coverage is the coverage that is made available to protect the entity. That's because in most D&O suits, both the individuals and the entity are named. Because of that, say your organization has $1 million limit, if you do not have an excess side A dedicated limit dedicated to protect the assets of the individuals, because both the entity and the individuals are named, along the way, that $1 million that's shared with the entity could get eaten up with defense and indemnity, which is why you always want a dedicated side A limit on your D&O policy. More common D&O claims that we typically see in the news are in the areas of oversight of employment practices, of fiduciary liability relative to sponsored employee benefit plans, as well as cybersecurity and crime. So these are situations where the underlying action is not technically a D&O claim. So for instance, Me Too, or the hashtag Me Too movement, or wage and hour movement. So you have the underlying employment practices violation in defense. If it is a bad enough violation or it's very systemic, there could be an allegation that the board was asleep at the wheel and was not looking into what basic controls are for employment practices. So for instance, is there a uniform application for employment that's used, or does the entity sometimes just hire people without an application? Do you have an employee handbook? Is there discrimination training? And do you technically, are you able to, or do you recommend that you involve third-party legal when firing an individual to make sure you can protect the entity? Similar things in terms of oversight of fiduciary. The biggest area in fiduciary we see right now are excessive fees relative to retirement plans. So are the fees that your third-party 401k or employee benefit plan sponsor, are they in line with other entities? So if that fee is, say, even 0.25% higher than what your peers are benchmarking against, you're essentially not allowing those retirement assets to grow the same rate as others. So do you look at your fees annually? Is the plan compliant with ERISA? And are the investment options that are being offered, are they in line with other plans? If all of those things all those boxes aren't checked, you could potentially be subject to oversight relative to the fiduciary liability plan. So is there an annual review? Are you with a reputable provider? And how do you benchmark against other plans relative to fees? Cyber and crime is another area where we want to make sure that the board is aware that you do have cyber controls in place that are reasonable. So do you have MFA, multi-factor authentication? Do you have endpoint detection? Do you train your employees? Employees are still the biggest area where bad guys get into systems. So are there phishing exercises so that your employees aren't clicking on bad links? Does your firm have an incident response plan? Do they know what they're going to do when the cyber attack happens? And is the board aware of a bit site score and a black light score, which I'll talk about here in just one moment. So taking control. Easy things that you can do as a board member is ask your organization, what is the bit site score? A bit site score is, the easiest way to understand it is it's like a credit score. It is a tool that cyber underwriters use to try to determine how cyber fit the organization is. It is in no way meant to be comprehensive. It is, envision someone on the outside of a house looking in. So are certain controls in place? So for instance, is the patching on the organization current? This bit site score will tell you that. Do you have any open ports? This bit site score will tell you that. Oswald has invested in this technology for our clients. And so we run bit site reports on all of our clients 6 months before their cyber renewal. That tells us where their potential weaknesses are so that we can work with our clients to fix those weaknesses. So when the cyber underwriters pull it, they look really good. If you're interested in a complimentary bit site report, as well as some consultations surrounding what that report means, you can just scan this QR code and Cody or Josh will give you a call back and we can help you out with that. Another tool that you can look at is something called Blacklight. It's a real-time website privacy inspector. So an emerging risk that you should be aware of is consent and disclosure relative to a website. So this is where your website might have ad trackers on it or cookies, and you may not even be aware of that. Many of our clients, when we help them run this, they're not even aware that they have these ad trackers or third-party cookies. And so they can remove them, reducing their risk exposure to disclosure, consent and disclosure relative to private information for folks who visit your website. So as a board member, if you're looking over the insurance program that you have, you're going to look at your property casualty, you're going to look at your automobile, the umbrella, the D&O, of course. You're also going to look at your cyber program and your crime. If you do have a dedicated cyber policy, there are complementary cyber resources that come with it that can help you and your organization. So examples of online resources that the leading cyber carriers offer are employee training modules, mock phishing exercises, very, very valuable. But probably the most valuable thing you get when you have a dedicated cyber policy is when something goes wrong, you have an outsourced disaster recovery plan. You have someone to call, which they call a breach coach, that's going to tell you what to do, who can navigate, this is the right IT forensic firm to use, this is the kind of attorneys that you need to have depending on the kind of breach that you have. And they can also connect you with a crisis management firm to help you manage the message. So again, you could have a cyber policy in place, you should not put it on the shelf. These are resources that you pay for in the cyber policy, and we find that a lot of clients just don't use it just because they purchase the cyber policy and they put it on a shelf and they hope they never have a claim. But these are resources that are available to you through your cyber carrier. Other complementary resources that are available to you provided by leading D&O insurers. So your D&O policy many times is packaged with employment practices and fiduciary for your employee benefit plans, potentially with your crime as well. Those leading D&O insurers can offer you articles and checklists to help with your governance. There are best practice minute videos that the board and leadership can use. There are podcasts, and there's even sample employee handbooks, because a lot of our smaller nonprofits don't have an employee handbook, and so you can download an employee handbook and have that for your employees to help protect you. So in terms of takeaways and taking control, I've tried to put everything on one slide for the board to think about. So for the D&O, are the board members appropriate for the operations? Are they engaged, which we've talked about a couple of times in this webinar? Do they meet regularly? Is there active participation? Are you cyber savvy? Are your bylaws up to date? And do you have a comprehensive D&O insurance program with a dedicated Side A limit? Employment practices, you want to make sure that you have wage and hour compliance, that you are in compliance with the FLSA Act, that your job descriptions are the job descriptions for exempt employees, truly exempt employees versus non-exempt. Are you doing background checks, performance reviews, other suggestions for fiduciaries, making sure you've got a reputable employee benefit provider, the fees are in line, and then cybersecurity, of course, is a big issue. Many of the things I talked about previously here, you want to make sure that your organization is doing. And then relative to artificial intelligence, very important, do not allow your organization to upload any information into an AI interface, because you can never really get it back. So then you're sharing private information. You should establish an AI policy and make sure that your artificial intelligence supplements human intelligence. It does not replace it. I do have some additional information here I know that you'll be sending out, but I think in the interest of time, we're at time, so I believe this information will be sent out.
Thank you so much, Kim. Just really fantastic. I love that last page with the takeaways and how to take control. What a fantastic tip sheet for folks. So, well, thank you again to each of our fantastic speakers. As we suspected, we would not have time for a live Q&A, but if anybody did submit questions, we'll be sure to follow up with you directly. So thank you, Terry, John, Tom, and Kim, for sharing your expertise and examples as you help all of us think through risk management roles as board and staff members with nonprofits. I want to ask you to keep your eyes peeled for additional learning opportunities with HW&Co and BVU. We will be doing another of these quarterly webinars, probably coming up in November, as we share some of the findings from the spring survey that we did, kind of take a peek behind those numbers and see what's going on with our nonprofit organizations. And then also of note, and again, a great takeoff from Kim's last point around artificial intelligence, BVU's annual Civic Leadership Summit is coming up on October 24th, and this year's topic is AI for social impact. So we'll be talking about risk management issues and the ethics around all of that as well. We'd love to have you join us for that, and we'll send out additional information as well. So if you're with a nonprofit and want to talk about how BVU can support your mission and your work, please reach out to me. You'll get my contact information in the follow-up. Also, again, thanks to our friends at HW&Co for their support and expertise along the way. Thanks to each of you for sharing and spending some of your Wednesday with us. We hope you have a great rest of the day and a fantastic week. Take care.